Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. To sign up for my letter, as well as Chen's letter, go to miningstocks.com, or call our number in New York at 718-457-1426, 718-457-1426. I do want to thank Dynacert. That's the company that has a technology that can reduce fuel consumption in semi-trucks by over 14%, and is also eliminating carbon emissions by 30 to 40%. A real great story, a real great company. We've talked to the CEO on this show, expect to have him on sometime in the near future. I think this is a company that you want to keep your eyes on as a potential investment. It's doing quite well. Of course, the proof will be in the pudding as the company starts to generate sales imminently now. We look forward to keeping you up to date on that. Today I am attending the Cambridge House Conference here in Vancouver, British Columbia, so this show was pre-recorded at the end of last week. I have titled today's show, Exit the Banking System as Soon as Possible. Well, because of a shortage of time and the amount of material to cover, I want to welcome Ellen Brown, my first guest, right away. For those of you who may not be familiar with Ellen, I think most of you probably know her because she's been on this show before several times, and she is certainly out in the public a lot, but she developed her research skills as an attorney practicing civil litigation in Los Angeles in Web of Debt. Her latest book, she turns those skills to an analysis of the Federal Reserve and the money trust. She shows how this private cartel has usurped the people's power to create money and how we, the people, can get it back. Ellen developed an interest in the developing world and its problems while living abroad for 11 years in Kenya, Honduras, Guatemala, and Nicaragua. She returned to practicing law when she was asked to join the legal team of a popular Tijuana healer and an innovative cancer therapy who was targeted by the chemotherapy industry in the 1990s. Well, that experience led her to her book, Forbidden Medicine, which traces the suppression of natural health treatments to the same corrupting influences that have captured the money system. Ellen's 11 books, including the bestseller Nature's Pharmacy, was co-authored by Dr. Lynn Walker. So she has a very impressive background, a prolific writer, and works very hard. And what I really love about Ellen is that she really puts her heart and soul into things that are really good for her fellow man. And so that's why I really love to have her with me. Thanks for joining me again, Ellen.
Thanks, Jay. It's great to talk to you. Always
good to talk to you, and I know that there are a number of interviews. I would suggest that my listeners go to ellenbrown.com. A number of interviews and articles that you write are there, and things that I think I would really like to have my listeners follow up with after we speak with you today. Ellen, most people have no idea about how money is created in our fractional reserve banking system. It's a mystery. I mean, most people that carry the currency around in their pocket, they think that is money. But actually, that is a very small percentage of the amount of money that's out there. And in fact, we have a debt-based system, a monetary system. Can you explain to our listeners how money is created essentially out of nothing?
Well, it's actually created when banks make loans, and money reformers have been saying that for 100 years, at least, or more. But the Bank of England just acknowledged it a year ago in their quarterly report. They said, contrary to popular belief, banks do not lend their deposits. They don't take in deposits and lend them out again. They're not just intermediaries, that they actually create deposits when they make loans. Mm-hmm. So here's the way, and another way you can prove that is to look at a chart of the money supply. So the M1 or the M0, the money that's actually created by the government, is a very low line at the bottom, and then you have this exponential line at the top, which is M2, which is the circulating money supply. And where did all that come from? It's not coins, it's not dollar bills. It came from banks when they make loans. So the way it works would be, say you go to the bank and you take out a loan for a mortgage for $500,000, and the bank, without even looking at what they have in the way of reserves, they'll just write you write $500,000. If you're creditworthy, they'll write you $500,000 into your deposit account. So when they count the money supply, they count deposits as part of the money supply. So they've just increased the deposits by $500,000. So you'll probably write a check to your seller, which might go into another bank. Now, the first bank has to balance their books at the end of the day, so in that sense, they are using their deposits. But I think they have 2 weeks to actually balance it all up with the Federal Reserve. And so they will be getting in deposits all day long. You know, they come in and they go out. And if they come up short at the end of the day, what they can do is borrow from another bank. So let's say they borrowed from Bank B, where that your check just went, the money they just created. So they could be borrowing back that same $500,000, paying a very little interest on it. The Fed funds rate was 0.25%. I guess it's gone up a bit. And or they could, if nobody has the reserves, they can borrow from the Federal Reserve, which creates them out of nothing on their books. These are the reserves, but it's a complicated subject. The reserves and the deposits are exactly the same thing, but they go together. Anyway, that's the way it works. So it looks like when you're getting deposits in as a bank, you say, well, that's real money. You know, we've got real deposits in. But where did those deposits come from? All of it, except coins and paper dollar bills, were created by banks in the form of loans.
Right. It's a mystery, and I think you explained it very well. Most people don't have a clue. They just figure it's, dollar for dollar. Everything is there, and it's really created out of thin air, essentially. Now, most people believe, of course, that when they put their money in the bank, in the Federal Reserve banking system, we use J.P. Morgan here in New York, that when we put our money in the bank, that it is still our money. But legally, it's my understanding, Ellen, that we are now unsecured creditors to that bank. It's no longer our money. It's a loan that we've made to the bank. Is that right?
That's correct. That's been the law ever since the 19th century, where it was the depositors' money, and they got so nervous about it, they were trying to tell the bank, oh, well, we don't think you should make that loan, or that looks too risky. And the bank said, well, we just can't operate this way. And so the courts said, okay, we're going to say that when the bank gets the money, it's their money, and the depositor just has an IOU. So that's why they pay you, like when you look at your bank statement, it says 0.1 cents or something for interest every month. That's why they're paying you interest, because you are supposedly a creditor of the bank.
Yeah, well, they're not paying very much. I know they're not paying me anything for my demand deposits, or very little, if anything, almost nothing for my savings account as well. And but that's another topic I want to get to if we can. The idea, of course, that we're lending money, so we should be compensated not only for the time value of that money, but also for the risk. And that's what I'd really want to talk today about is the risks that we're facing when we put our money in the banking system. Now, you talked about how M0 is very small, and then, it's M1 and M2 and M3, and I guess they don't use M3 anymore, but how it's exponentially larger. But then much larger than that, those measures of money, is something called derivatives. Derivatives that are hugely larger than the money supply. Can you talk to us about derivatives and why they are posing such a threat to us right now?
Mm-hmm. Well, I think the official figure now is something like $1 quadrillion. Which
a quadrillion? What is that? I can't get my head around.
Yeah, a quadrillion is 1,000 trillion, and a trillion is 1,000 billion.
Mind-boggling.
Yeah, it's unfathomable sums. And the reason it's such a threat is that under the Bankruptcy Reform Act of 2005 and the Dodd-Frank Act of 2010, derivatives go first in a bankruptcy. So it used to be that a bankruptcy, when a bank went bankrupt, that they would sell off the assets and pay off the creditors would stand in line. Now, what the new thing is bail-in. Now they take the creditors' money in order to prop the bank up. So the bank does not go bankrupt. It just goes on its merry way, carrying on business, getting bigger and bigger, as we're seeing the big banks do. And the creditors' money is taken. And little known to most people, we are also creditors of the bank. So the derivatives claims are technically they're not even part of the bankruptcy. Like they're not. It used to be they weren't subject to the automatic stay, and I guess now they're voluntarily subject to it for 24 hours, or 48 hours, I think. But it's not very long. It's not long enough for the bankruptcy trustee to figure out who's getting what. Anyway, so the derivatives claims go first. They get to snatch the collateral, and if we don't even know what a big derivatives bust would look like. Lehman Brothers was not that big compared to the amount of derivatives that, say, J.P. Morgan or Citigroup, the really big derivatives banks have this ominous amount of derivatives on their books. And so we just don't know. We could be facing a much bigger collapse than with Lehman Brothers, and that would wipe out the collateral of the bank, including state and local government deposits, which are not, they're supposedly secured with collateral, but they're not insured. They're way over $250,000, so they don't come within the FDIC insurance limit. But they think they're, if you talk to politicians, they say, well, we're not worried because our deposits are secured.
Yeah.
But their security falls in line behind the derivatives players. So the derivatives players get the money first, and there just might not be anything left. And even for us, the insured depositors under $250,000, we're insured. The money will be gone. We're insured by the FDIC, so the FDIC then has to step in and pay us. But they only have $67 billion in their insurance fund, and the amount of insured deposits is something like $6.5 trillion.
Oh.
And they have a credit line with the Treasury up to $500 billion, but that's just a credit line. First of all, who's going to pay that money back? If it's up to theoretically, it's the banks that pay the premiums, and that's where the Fed fund money, the FDIC funds money comes from. And when we went over, or when the FDIC fund went over, or went in a hole by, I think, $8 billion in 2009, a number of little banks almost went under. These were huge premiums that they could barely pay. So either we're going to break the little banks, which it looks to me like they're trying to do anyway, force them to consolidate with the big banks, or we, the taxpayers, are going to be on the hook again, just like we were before. But in any case, our deposits are at risk, our public deposits are at risk, and the whole banking system is so corrupt. We've just seen one thing after another. There's things like The Big Short. There are movies now about it. Right. So people are really getting the picture that this is not necessarily where you want to keep your money.
There was a time, Ellen, when commercial banks were commercial banks and investment banks were investment banks. The investment bankers were entitled to their huge profits because they were taking bigger risks, and the commercial banks were not taking such risks. And in fact, I think they probably didn't have or weren't tied into those dangerous derivatives you're talking about, at least not to the extent they are now. Glass-Steagall was removed during Greenspan's tenure at the Federal Reserve during Bill Clinton's presidency. Was that the start of the kind of problems we're having now? Was that a big part of the reason we're in trouble now, in addition to the bankruptcy revision law and Dodd-Frank?
Yes, well, that is why we have this big risk, because there were 5% of the derivatives that were not supposedly covered by FDIC insurance, or that you couldn't gamble with your deposits for a mere 5% of these derivatives. And a year ago, in the omnibus budget bill, Citigroup petitioned, quietly, leaned on everybody to get that 5% taken out. So now, virtually all the derivatives are covered, and this would include the oil derivatives. These are bets against the collapse in the price of oil, which Citigroup had a lot of, and so that presumably that was why they were so concerned. So we, the people, again, could be on the hook for all that. Yeah. And derivatives are what essentially got us in trouble with the subprime collapse, because it used to be that banks would keep loans on their books. So, of course, they're interested in making sure these people pay up. So they wouldn't take bad loans or bad, loans where they weren't sure how they were going to get their money back. But once the banks were able to sell it off to investors, then they didn't care whether they were really good pays or not. They just had to convince the investors to buy the things. And the way they convinced the investors was they said, well, don't worry about risk because we protected it with derivatives. What nobody was figuring on is that this is not real insurance, and it's not like there's a government agency that checks to make sure they've got the money to pay up. In fact, nobody knows who the counterparty is on your derivatives, so it could be some outfit that just goes bankrupt, which is what happened in 2007 when two Bear Stearns hedge funds went bankrupt, and that's what got everybody all upset. Like, oh my God! You would covered after all.
You would think, Ellen, and I think that probably the derivatives gave that sort of false sense of security that the system was secure, and maybe on an individual basis, as long as the system itself was good, it was helpful to businesses. If you wanted, if you needed a fixed rate loan, you could get it. You could borrow floating and change it into a fixed rate, and there might be someone on the other side of the trade that wanted the other side. It gives that false sense of security, and then the huge amounts of money that was pumped into the system that allowed it to expand. And then you turn around and say, well, sorry, the banks can make the profits, but when you have the system breaking down, taxpayers, you're going to have to pay for it. It's just so immoral. It's just so horrible, it seems to me. Alan, could you explain bail-ins? What is a bail-in? Because this is what we have coming our way now, I guess, starting in Europe, right?
Yeah, a bail-in in Dodd-Frank and also in the European Banking Union deal that was just, I think it was formally agreed to a year ago, I think. And Dodd-Frank was 2010, and President Obama went on TV and said, no more bailouts. That's what it meant, no more bailouts. No more too big to fail, supposedly, but actually what it does is make too big to fail permanent. But what they do, instead of the government bailing out banks that are insolvent, the creditors are supposed to bail them out. In other words, they tap up the creditors' money. Yeah, which you think, well, okay, the shareholders, they took a risk buying the shares in that bank, and so they have to eat it, and it's only fair. But you're not thinking that the creditors mean the shareholders, the bondholders, and the depositors. And in fact, the largest class of creditor of any bank is the depositors. Now, for most of us, we're probably under the $250,000 limit, but then you've got all these businesses that have to keep a large amount of cash for their cash flow, to pay
payroll
and all. That's what happened in Cyprus. Was the shot across the bow. So that was the first week.
The first bail-in.
Yeah, and the people that were really hurt were the local businesses because they lost 50% of their money, 50% of their deposits, and they needed that money for their cash flow. So that meant that they either went out of business or they cut way back on their, laid people off, etc. So the whole economy really suffered just from this bail-in of two big banks. And now we've seen, so in Europe, starting in this month, last year they were bailing in bondholders and stockholders, but this year, starting in January, they're also including depositors. So two big bail-ins that I know of that were fairly shocking and disastrous was one in Italy. There were 4 banks, and they weren't even what we'd call too big to fail banks. There were 4 local banks that had been insolvent for a couple of years, and they were trying to work this out. And they took the money of the bondholders. So these were people that had bought bank bonds. So the reason it made the news was one pensioner hanged himself. He lost 100,000 euros. It was like all his money, retirement money.
Tragic.
And left a note and blamed his bank, where he had banked for 50 years. He thought they were reliable, and they probably really were. It wasn't the bank's fault so much. It was
system
policy that they were forced to do this. Yeah. And then just like last week or the week before, just recently in Italy, they had one of these good bank, bad bank situations. So if you were a bondholder in the good bank, you thought your bonds were perfectly good, and all of a sudden, just sort of arbitrarily to bail out these banks, they moved the good bank bonds into the bad bank.
Wow.
So suddenly they lost 80% of their investment. so this is going to, first of all, it's going to stop people from, they're going to certainly think twice about buying bonds, bank bonds, which is a big source of capital for the banks, which they're needing more and more of because of heightened regulation. And it's just, it makes the whole banking system very, very insecure. So,
all right. Well, that's
public bank.
Well, that's in Europe, but the United States is not that is a much stronger, safer country, right? Everything is honky dory here. I mean, we're the United States of America. We don't have those, and we don't have the problems that Europe has. We're a much stronger economy. We don't have the problems that Asia has. But you're saying, if I understand you, that we are also being threatened with bail-ins. You mentioned Dodd-Frank has a provision in it, does it?
Yeah, and we're in some ways we're actually more vulnerable than they are because of this Bankruptcy Reform Act provision and Dodd-Frank provision that says that the derivatives go first in a bankruptcy, so they're first in line. And we have our too big to fail banks are hugely loaded down with derivatives. I think it's something like $247 trillion worth of derivatives.
Incredible.
5 big derivatives banks, yeah. A huge sum. So we could be very vulnerable. And
you mentioned then, if I understood what you said earlier, that our laws really give these derivative guys the advantage over us, over the common folks.
Yeah, and you know who they are. They're basically the bankers. Every over-the-counter derivative has a banker on at least. I mean, the banks set these things up. They're the house, so the house always wins.
Yes.
They understand the game where the Patsy pension fund or local government or whatever that takes the bet is probably probably doesn't get it and probably going to lose.
I remember when Alan Greenspan backed that up, totally, when he was at the Federal Reserve back in the Clinton days,
saying that the banks needed to make some money. We needed to compete with the other banks.
Yeah, right. The other banks around the world. Yeah. Anyway, it's as you say, the casino is the house wins. And the house is rigged, and that's the way it is. But you, Alan, have been an advocate of public banking, and you just started talking about it, and I know that you are involved, I think you're involved at least, with a public bank in the state of North Dakota. I think it's the Bank of North Dakota. If you put your money in a place like the Bank of North Dakota, do you feel safer than if it's at J.P. Morgan Chase?
Oh, I definitely would, but I don't think you can do it as an out-of-state. That's why it's a great model, and it's worked really well for them. Even it used to be that people would say, well, they've got oil, that's why North Dakota's doing so well. But now oil is doing poorly, and North Dakota is still holding its own because they've got this great bank that's got reserves, and so it's kind of like China, and they can double down when things go bad. They're putting even more money into local projects to keep the economy revved up.
Is that because they've been conservative, Ellen? They don't have sort of reckless lending policies that might be undertaken by banks that know they can always get bailed out, or that the creditors, the depositors, will bail them in now? They know government's got their back, and that's the system we have, as opposed to a Bank of North Dakota that is responsible to the closer home to their own people, the citizens of North Dakota. And then is that how you account for them being more responsible in their lending policies? Is that why they're in better shape despite a bad oil economy now in North Dakota?
Well, that's one reason. The Bank of North Dakota has been in business for 100 years. And they don't do derivatives. They say, if we don't understand it, we don't do it. I mean, it's just old-fashioned North Dakota sort of mentality. I mean, they're a conservative state. It's not like a socialist state. And their whole business model is just very efficient. So instead of putting their deposits in Wall Street for Wall Street to gamble with, they put their deposits in their own bank. By law, all of the state's deposits go into the Bank of North Dakota. Then they can use those deposits, to do what all banks do, make lots of loans they have a mandate to serve the local economy, and they have particular sectors that they particularly give low interest loans to, education, agriculture, and energy particularly. So they give like 1%, or I think it's now 1.7% loans for students, 1% loans for startup farmers, that sort of thing.
Mm-hmm.
And they don't have any high paid. They don't pay bonuses, fees, commissions. They don't do gambling, or other than making ordinary loans. And they partner with the local banks. So the local bank is sort of like the front office, and the Bank of North Dakota just comes in and participates in the loan. So they don't really have much in the way of cost.
Mm-hmm.
And the highest paid person is the president, who makes somewhere on the order of $250,000 a year. Nothing compared to, I think it's $20 million for the CEO of Wells Fargo. They don't have to advertise for deposits. They've got a built-in deposit base. They don't advertise for customers, because they get to go out and seek. They get to choose the projects that they want to invest in. And of course, the local banks are real happy to have them.
Sure.
To allow them to do larger loans. And what they do for the local banks is they guarantee the loan, so they effectively substitute for capital. So they help with the capital requirements and help with liquidity.
Mm-hmm. Well, that's all very good for if you live in North Dakota. What about me? I live here in New York City now. I know that Mrs. Taylor, who takes care of the financial end of things here in our little business, likes to stay with J.P. Morgan Chase because it has so many conveniences. That's one of the reasons she doesn't want to change to other banks. But let me ask you, before you comment on that, what about putting your money in a local, let's say, a credit union or something like that? Would you be safer with something like that than, say, the Federal Reserve System?
Yeah, well, you are in theory, because they're not too big to fail banks, so they're not subject to bail-ins. I mean, they're not in the Dodd-Frank Act. But you still might want to check with the bank and find out, do they do overnight sweeps where they put their money in Wall Street overnight? Because the big banks are going to go bankrupt overnight, as they always do, off hours. And do they use big correspondent banks and check the credit rating, maybe with, I know Weiss does credit rating.
Yes.
Yeah, so you still want to check carefully and watch the news, because there's a lot of pressure on the local banks and the credit unions. They're trying to force them to, it looks to me like they're trying to force them to merge with the big banks. Rules could change and seem to be changing. And generally, you probably don't want to keep a huge amount of money in any one place.
Right. So, I mean, credit unions or possibly some savings and loans institutions that are conservative with the way they lend their money, but if they're tied into the whole system, and this is what I think the Fed wants, is a monopoly, and it essentially has a monopoly over a major part of the economy, and then and to sort of pull everybody into the system so that nobody can protect themselves, essentially. And the convenience issue, I would imagine that the Bank of North Dakota doesn't offer the kind of conveniences. I mean, I think it has one branch, essentially, one main office, one main facility, where here, we can go anywhere in the tri-state area or whatever around the country and pull our money out of J.P. Morgan Chase. Or, for commercial banking, it's easier too with our merchant account and so forth than it would be to go to a savings and loan or a credit union or something like that, I guess. So they sort of have you locked in with this convenience thing. They keep you sort of sucked into the system, don't they?
Yeah, that's a problem. Well, yeah. So, if you're a business, I don't know what to recommend, because you need those big banks, and that's what the state and local governments have too much money and too much business to use credit unions or to use the small local banks. So they use Wall Street because they have to, and that's another argument for setting up your own bank. I mean, it's just they're losing so much money on. You keep seeing articles about shocking fees that nobody was aware of, and not to mention whatever it was, the $5 trillion or something that got wiped out from the subprime scandal, which was all Wall Street's doing. I mean, it's so expensive and so risky. It just seems to me it would be worth state and local government's time to look into setting up their own bank. In California, we have an infrastructure bank, so we've already got a bank. It's just not a depository bank. They can come up with, they've got the ability to change the laws. That's what laws are for. I mean, that's what Congresses are for,
right.
legislatures are for.
Well, Ellen, we're just about out of time here, but I know that you are a tireless advocate for an ethical banking system, a public banking system that looks after the interests of the people. And I'm so grateful that you're doing that work. Where you're speaking in a lot of different places. I know you're very active, and I would just like to tell our listeners to go to ellenbrown.com. There's maybe just ask you to comment very quickly on an article I haven't had the time to read yet, but one that you've posted there, I guess just very recently, is "The Citadel is breached. Congress taps the Fed for infrastructure funding." Could you talk to us just briefly about that and tell people why they should go there to read this?
Okay, well, our infrastructure has been falling apart for a long time, and both parties, both houses have been on it and said we have to do something about infrastructure, but they couldn't agree on how to fund it. So they finally came up with the compromise that they would hit up the Federal Reserve, which is about time, if you ask me. So they're getting the money for this $305 billion transportation bill partly by taking a portion of the dividends that for 100 years, ever since the Fed was founded, have gone to the member banks, their shareholders. It's the Fed is composed of 12 branches, all of which are 100% owned by the banks in their district.
Sure.
So it's partly that, and then partly they took it out of the reserves of the Federal Reserve, or the capital surplus. The Federal Reserve doesn't really need a surplus because they have the power to create. And Ben Bernanke admitted to that, but he said in a blog, but it looks bad, to be hitting up an independent central bank. So the point is they're not independent anymore, which to me is good.
That's a good thing.
They're not. They've never been independent of Wall Street. They're just dependent of the public interest. So,
contrary to what the Congress designed, right? Yeah, our Constitution.
Even when they passed the Federal Reserve Act, it was so obscure. It was William Jennings Bryan was the opposition, and he said no way would he ever approve of a bill that gave the power to create money to Wall Street.
Sure.
And when he saw the final bill, he said, at last, the people will be issuing the money themselves.
Oh, hardly.
Which wasn't true. It was just so obscure that even when it was passed, that people didn't understand it.
All right. Well, unfortunately, we're out of time, Ellen. Always a pleasure to talk to you, and it's always insightful. And I just, again, want to thank you for being on our show and wish you all the best. And if people want to get behind your efforts, I guess they can do that. How can they do that? How can they get involved if they want to? Our
website for Public Banking Institute is publicbankinginstitute.org. You can sign up for the newsletter, and there are many other suggestions there on the website.
Excellent. Thank you so much for being with us once again, Ellen, and we look to talk to you again sometime in the near future. Very much.
Okay. Thanks, Jay.